welcome to a brand new show of Market Makers. We've seen a sizable comeback in the market, more like a monster rally if I look at where markets are from the recent low. The interesting bit is that markets are not far away from an all-time high. The ring of all-time high, I think, is actually real. But is this as good as it gets, or markets genuinely now have, or Indian market genuinely now this time have decoupled? So let's discuss market valuations, themes, and the recent bout of outperformance. Is it here to stay? Let's discuss all that and much more with Ravi Dharamshi of Value Quest. Ravi, fantastic to have you back. Let's do a high five.
Thank you,
for the first time after COVID.
After a long
so
time,
nice.
yeah.
Yes, in person it's the warmth and the conversation is always different.
Absolutely, it's good to be here.
We saw a massive sell-off, April, May, June, and we've seen a monster rally. Do you think it was stretched on both the sides? First the decline and now the rise?
March of 2020, when the shutdown was announced, actually we made a bottom a day after that. But that was the time when it was complete chaos and people had no idea how the economy was going to pan out. Since then, because of the structural and cyclical factors, we have started a new bull market. And in my opinion, whatever happened in the last 9 to 12 months is more a cyclical or a corrective phase rather than bear markets starting. So if one has to have that view, then it was only going to be a matter of time before we resume the uptrend again. And I think we have pretty much started on that uptrend is what I feel.
So like they say that your birthday comes once in a year, but correction can come more than once in a year.
Yeah. So corrections can be 5% is a dip, 10 to 20% is a correction in my opinion, and more than 20% is not a bear market in my opinion. See, there were genuine headwinds. There was war, there was inflation, there was interest rate rising. So enough reason to be concerned, and some amount of valuation correction was required. But at the same time, all these macro headwinds are going to lead to some kind of a margin impact, some kind of maybe profit impact. But nothing is going to really impact the balance sheets of Indian corporate or so to say even India Inc. I mean Indian government's balance sheet. So the balance sheets are strong. And if that was to be the case, once these headwinds recede, whether it is the inflation or whether it is margin impact due to this inflation, the growth trend will start again. We have yet to witness a up cycle. The housing cycle is just beginning. It's probably 12-18 months we are into the housing cycle. Credit growth cycle is just beginning. None of the corporates are really leveraged. So leverage is at an all-time low. So if that is the case, then how can we possibly enter into a recession or any kind of a downturn which can last for a long period of time? So that is where I'm coming from. This was a correction. We have corrected. We have shown fantastic resilience in that correction. So yeah.
And some of the headwinds are structural, and some of the headwinds are so strong that we've never seen a world like before. US inflation 40-year high, war in Ukraine, commodity prices, mean reversion happening in other asset classes. We cannot be dismissive about them.
No, I don't think we should be dismissive, but at the same time we should be a little bit more nuanced. What is probably structural for US might not be structural for India. So for example, inflation that you mentioned, a lot of it is driven by home prices and wages in US, while over here it is driven by food and commodities. And already we have seen that the commodities have cooled off more than 30% from the peak. Even fuel for that matter is coming down. So in my opinion, the inflation over here is far less structural than it is in US. Also, most of the time you have to look at the point from which this the whole factor is panning out. In US, the corporate profit to GDP had gone to 11-12%. That is like not only decadal high, it's like all-time high. When valuations are based on profitability which cannot sustain, then obviously the valuations will correct far more. While for us, the corporate profit to GDP cycle was just about turning. It has just turned in the last 18 months. Now, as I mentioned earlier, the profits are at a high since last 18 months, but the capex cycle had not yet picked up. So companies are making profits, generating cash flows, capex is at a low, and capacity utilizations are rising. So obviously now the companies are going to be spending money to do capex to enhance their capacity because they have the comfort of demand sustaining. So I would say these structural factors are more so for the developed markets, or maybe US and Europe specifically, and not so much for Indian market. So that is why India has shown this kind of resilience.
Okay, I'll take your note. And anti-fragile India in a fragile world. It's available on your website?
Yes, of course it is available.
Okay. Now, why am I using this as references? Because let's look at the markets. When we were at 17,500 last time, end of 2021, the lay of the land was different. It was all about digital, 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 digital. Fintech companies are going public. Metal stocks were at a record high. We are back at 17,500, but the market setting is very different.
Correct.
It's banks, it's autos, it's cyclicals.
Absolutely.
Why is that? What are markets telling you?
No, so we have also changed our portfolio accordingly.
Oh, really? I thought you have a 3-year
yes,
time frame for everything.
So we have also changed away from the IT platforms, pharma, chemicals, sectors that were a beneficiary of.
Am I hard of hearing because you said you've sold pharma? I thought that's your
No,
suit.
we are underweight, let me say. We still continue to hold. But what I was trying to say is that those were beneficiaries of a short-term cycle. Of course, we realized that along the way. I won't say I had the foresight to see that. But COVID led to a lot of,
Sugar rush is the right word.
sugar rush is the right word, absolutely. Where everybody started, okay, there is demand and I don't have inventory. There was a period where most businesses could not fulfill the demand. So they went on an overdrive and stocked up more. And now those demand drivers are gone. And suddenly they are seeing themselves stuck with inventories. So whether it is pharma or IT, in IT also, a lot of it was driven by the US digital boom. Now, obviously, there is a real slowdown happening over there. The hiring, there are layoffs happening. There is some amount of slowdown in the spend. So that is going to have its second order effect on Indian IT. So, and these were the areas where valuations were on a high. So market was assigning high valuation multiple to profits that possibly could not sustain, at least in the next 1-2 years. Maybe the structural theme can again come back a couple of years down the line, but at this point it is not clear whether the structural demand will sustain or no. So hence those areas are now out of favor, and obviously with the market cycle, fund managers also tend to get over allocated to the performing sectors. So that is why they are going to be underperforming, in my opinion, for the next 1-2 years. While on the other hand, these spaces like auto, engineering, cap goods, financials, these were the ones where suddenly the market realized that everybody is underweight and the things are actually changing for the better. The domestic cyclical economy is picking up and is resilient in the face of this macro headwinds. So hence this initial set of reallocation towards this sector has happened. Some amount of rally has happened, but I don't think the cycle has yet completely panned out. We are looking at good 2-3 years of upcycle in these sectors.
So let's say post-COVID, if 70% of your allocation was global, now it is the other way around.
Yeah, I mean, I don't know the percentages exactly,
Broadly.
but yes, broadly we have.
Heart of the portfolio.
Yes.
Heart of the portfolio is not domestic. Okay, pharma, I understand that generic prices are under pressure, US FD audits are stringent, inventory losses, gains. It's a business cycle which has gone haywire. Yeah. But why IT? IT companies, what numbers we saw, they're still committing to a 10-digit, double-digit growth. They still have attrition issues, which means obviously demand is there. Otherwise, why will they have attrition?
So, Nikunj, I disagree over one thing, is that IT is a very predictable business. IT is not a predictable business. IT is the only sector that gives quarterly guidance, right? No other sector gives quarterly guidance. And yet, IT companies, even sometimes mid-quarter, come and revise their guidance down.
Yeah, QSQT, like I call it,
So
quarter se quarter tak.
And that just tells you that they don't know what their next quarter is going to be. So, having said that, IT is a great sector, and eventually I expect it to do well. But there had come a point where the valuation had gone from rock bottom in 2018 to a high of 25-30 times multiple for a sector that still struggles to grow beyond 15%, and where you have no idea what the next quarter's growth is going to be. And of course, we are facing margin pressure due to the great attrition that is happening. 25-30% attrition is huge. So those were the reasons why we have stayed away from IT.
Has consumer tech or fintech or the new tech become attractive again? We had Zomato management yesterday on the channel, and they use the word path to profitability in Nayanthara's interview at least 5 times in 5 minutes.
Yeah, no, so that realization has dawned on all these tech companies that funding is not going to be easy going forward. So you have to move to a business model that is sustainable. The land grab, I would say, in terms of just take as much market share as you can on investors' money, and then figure out along the way how you're gonna get profitable. So those days are probably over, or maybe the beginning of that phase is over. So going forward, obviously companies where the unit economics are in place, where the capital requirement is on the lower side, I would still be keen on getting into that space with a 5 years point of view.
Have you added anything there?
No, we have not. Valuations have become attractive, but not so attractive, yes, in our opinion.
Define your attractive. Zomato's market cap has gone, or the stock's gone from 160 to 40. What is attractive then?
No, so stock price, you can be expensive even from 40 to, if it goes to 20, you can still be expensive. Essentially, see, we need to, this path to profitability that was mentioned 5 times in the call needs to be demonstrated. There has to be a sense that there will only going to be 2 players and there will not be any further competition coming in. The margin pressure will ease and it is going to be focused on profitability. So it has to be demonstrated, I would say. So price might have fallen, but see, previously in these companies, the benchmark for prices were essentially the rounds done by previous private equity player. But that is not an exact science, right? You can be wrong. That most of the people are realizing that now, that IPO prices happened at a very, very high valuation, and so you need to be very careful in assigning valuations. So I would say things are not yet very clear, so I'll still hold back on adding to these names. But overall, I'm not bearish on this space anymore. I'll look for opportunities.
The way you invest, Ravi, is that you look at companies with 3 to 5 year time frame, companies which are on inflection point, market share gain or a business inflection. Where are those spots?
Yeah, so exactly what I mentioned earlier, that auto and auto ank is one such space.
Auto and auto ank. Okay. Let's pause here. Let's understand what you like within auto and auto anks.
So whether it is PV, whether it is two-wheeler, commercial vehicles. So our order of preference is commercial vehicles, then PV, then two-wheelers in auto. And we believe that last 4-5 years have been really, really bad for commercial vehicle cycles, and right now the numbers are at rock bottom. So the leading indicators are pointing to the fact that CV cycle is going to revive. Right now it is looking like it is only coming back to normalcy. But once we realize that whether it is the rural economy or whether it is the small businesses, they have all started doing well. The profits have come back. The average age of the fleet is at an extreme. So businesses need to replace. Fuel prices are also now coming down, with of course government being counter-cyclical and cutting the excise. So that also helps. So many things that had gone wrong are now slowly turning around. Cost of owning the vehicle had gone up. Even that is now cooling off. So freight rates are going up. So the cyclical upturn is visible. It is not fully into a full-blown upcycle yet. It is just about at the turn. And I believe the cycle upturn will last at least 2 to 3 years, if not more. We cannot predict at this point of time how long will it last. If 2 years from now there is a scrappage policy announced, maybe the cycle gets elongated. But at this juncture, it is safe enough to say that cycle will last 3 years.
Have you bought into the excitement around EVs?
It is very difficult to buy an EV OEM, because again it comes back to the same thing, that unit economics and the profitability is still under question, and EV is just entering the land grab space. Now when I say EV, it's more two-wheelers. Passenger vehicles are still far away from that, but the inflection point seems to have been reached in two-wheeler space. So there is going to be an impact overall on the mix of the two-wheeler sales. There is going to be more sales of E2-wheelers than increasingly market share will move towards E2-wheelers. So that is going to be a headwind on the incumbent players. However, there is a chance, there is a time when these people can, the incumbents can change their game, and they can also bring a product to the market which can get accepted. So I don't think that the first product is necessarily the one that is going to win over here. It is the best product. Whoever gets the best fit in terms of pricing, in terms of product what market wants, is the one that will win.
Now, there are two ways of looking at portfolio construction, which the way you look at it, one is you bet on classic compounders. India is going to grow, per capita is going to grow, we are going to be going on the path of progress, bet on obvious compounders. And then second, well, like you said, bet on cyclicality, which is autos and capital goods. What are the classic compounders you're betting on?
So, in fact, there are not two, there are many, many ways in which you can skin the cat. But what you need to figure out is what is your horizon. If your horizon is 3 to 5 years, then and if you are paying top dollar for those secular compounders, then it's likely that you are not going to make a lot of return. You are going to underperform.
What falls into the category?
Sorry?
What falls into that category? It's a great business, but it's not a great stock.
There are so many of those. Let me not name any company, but what was popular some time back is this buy at any price, BAP stocks or whatever. And also the fact that there was a narrative that only the larger are going bigger are becoming big. Sorry, big are becoming bigger. So I think there is a lot of broadening of the market. There is a lot of new sectors that are coming in, new companies that are doing well. So if you are going to be focused, you believe that there are only 100 companies in India that will do well, and within that only 20 are investable, then obviously you are going to maybe have a good time in some period, and it's a flavor of the season more than something that can sustain as a strategy over a long period of time. So I would say even if you want to buy structural, you have to still have an entry point where it is attractive enough to make money over a 3-5 year horizon.
Isn't pharma already down? Isn't it too late to sell? I mean, would you be looking at re-looking at the place now?
Okay, so there is a misconception that we are very overweight pharma. In fact, to begin with, our weight in pharma was very less, and we have further reduced the weight. You are right, the valuations are now at a much attractive point than they were at some point of time. So this remains a space that we will keep on our radar, but we still haven't seen the emergence of catalysts that where we can say that, okay, the worst is over and things will start looking up. So we are keeping it on our radar, and we will watch out for a cyclical uptick in these stocks also, but at this juncture we are still underweight.
How are you betting on financials? Because this is one space where the right to win is still with large banks.
Yeah. No, clearly we have gone overweight on the financials in the last 2-3 months, and it's not only large private banks, but we have bought NBFCs also, we have bought a smaller bank also, and we have bought a home finance company also. So we have bought financials across the spectrum, and we believe that of course it's going to be a cyclical upturn. Credit growth is just coming back. Rising interest rate scenario is actually good for the margins, and barring the short-term treasury losses that once they are factored in, I think the NIMs will actually expand, the ROEs will come back. This is the time where financial sector is overcapitalized.
Overcapitalized, under leverage.
Overcapitalized, under leverage, and yet they are growing at 20%, and the ROEs are still hovering between 10 and 14%. So there is a scope for these ROEs to go to 17, 18, 20% over the next 2-3 year period. So I would definitely want to be invested in financials, but of course we still do a stock picking within that. We are not exposed to any of the government-owned banks, or even within large private banks. There are some banks that are facing issues, whether it is related to succession or whether it is related to an acquisition that has been done. So we are trying to go with one of the large private banks where the story is pretty much clean and the runway is very, very visible with the next 3-4 years point of view.
Now, financials, unlike last cycle, are very disjointed. You've got private banks which have done rather well. You've got small banks which are at the lower end of the spectrum. The valuation gap between a large bank and a small bank is very wide. Do you think mean reversion will happen, or big banks will keep on becoming bigger?
No, I don't think there is. I think the big bank will keep becoming big, but it is not big more it's the stronger banks, I would say. So there are some state-owned banks which might be bigger, but if the balance sheet is not stronger, then they are not the one that are going to take away the market share. So it is the stronger that will become bigger, in my opinion. So clean balance sheet where the NPAs have been recognized. That way, actually, I think the entire sector is now pretty much clean. There are no negative asset quality surprises, in my opinion. There could be a one odd bank case, but by and large, the sector is clean that way. Now, the right to win will be with players, those who have showed up their balance sheet in terms of capitalization and are positioned in the right sectors within the lending space where the growth is going to come from.
How are you betting on the digital theme? I remember this chat we had, which was centered around digitization, product digitization, India becoming on the digitization roadmap. Your note, in fact, has a lot of mention of the digital India, UPI, Aadhaar, vaccine, COVID. How are you betting on this theme?
No, so you are right. Digitization is a theme that is going to sustain for a long period of time. But at the same time, I think we are going through a little bit of cyclical headwind in this sector at this juncture. Valuation had reached a little bit of extreme. So some amount of valuation correction is happening. The theme is going to last a long time. But a lot of this value at this juncture is getting captured in the private space. So, so to answer your question, how are we going about it? We are actually in the process of setting up a private equity fund to capture that. So, unfortunately, not many opportunities are available on the listed side, which are within the frame, within the time frame, and also within the risk-reward ratio that you would like to bet on.
Before we wrap, give me a flavor of your bets. Are these concentrated bets in this market? Have you diluted your bets and extended the number of stocks? How are you approaching it?
So we will never dilute away from the concentrated portfolio strategy.
How many stocks do you own?
So at a strategy level, we will not be more than 20-25 stocks. At a client level, we will never be more than 10-12 stocks. So that is something that we are very sure that we will never move away from that. Yeah, it's a double-edged sword. If you are wrong on a couple of stocks, it can impact the performance in a big way. When the times are tough, it becomes very difficult because your beta tends to be a little on the higher side. But we communicate that to our clients and let them know what kind of product that they are getting into. And but yeah, if we can manage those expectations and if we can manage the vagaries of the up-down cycle, this is the space where we believe that returns can be maximized.
Double-digit CAGR returns in mid-teens for next 3 to 5 years. Is that a reasonable expectation?
I would say so because finally, so if you see, we had kind of a lost decade last 10 years, barring that since 2020 rally. Prior to that, there were 10 years where the growth was not picking up itself. There were two components to that. One was, of course, the real GDP growth was falling. Second was the inflation was also falling, which was leading to nominal GDP growth being 8-9%. Now, real GDP growth has also come back and inflation has also come back to a little extent. And some of the inflation is desirable. So, I would say nominal growth is going to be 14-15%. If that is the case, the corporate profit should ideally track that. And if that is the case, then returns should also track that. Of course, you will still have to take your calls on the entry points, but again, entry point I'm not talking in terms of precisely timing, but over a 3-5 year horizon, you need to ensure that you don't come right at when everybody is saying this is the time to buy and everybody is saying, but you try and be a little bit counter cyclical, and I'm sure you can generate those kind of returns.
A lot of my friends who see you on TV, they say Ravi is only managing money for rich clients. They don't have a mutual fund, they don't have a SIP, it's only PMS and they only cater to ultra rich. It's a fair criticism, right?
It's not a criticism, that's how we are positioned and we would like to stick to that. That's our calling in life. We don't want to spread ourselves, we don't want to become a mutual fund, we want to stay boutique.
And money is coming at these levels?
I would say we had a large inflow in the last couple of months, and fortunately that came in at a very good time. We were able to deploy over the latter part of June and early part of July. So yeah, knock on wood, but things are doing well.
And when you speak to your clients, there is excitement about next 3 years, or there is a degree of cautious optimism? That's the most loosely used word in television, cautiously optimistic.
So we have a very cultivated set of clients, and they actually listen to, and they are very much in sync with what our philosophy is. So we remain bullish with a 3 to 5 year point of view, and they have a complete buy-in into our outlook.
Well, really appreciate your time. So glad
Thank
you
you
could
so
make it to
much.
our studio. That's it on this edition of Market Makers. Thank you for tuning in, ladies and gentlemen. Thank you for watching the show.